Hey everybody, welcome in. Today we're going to talk about how WTI and Brent, while everybody has been watching either WTI or Brent, something interesting just happened. WTI just took a premium over Brent. This is the first time it's happened in over 15 years. We're actually going to explore why. Why is this happening? What could it mean for news today into the future? And again, we're recording this on April 13th. 2026. It is very fluid dynamic. So if you are watching this 6 months down the road or something like that, the world may look a little bit different. So anyhow, let's go ahead and dive in. So why the world's most important oil spread just flipped. And by flipped, what I mean is that historically, WTI has been at a discount to Brent, and we actually track that over here on Energy Rogue. And what you can see here is I've got a chart right here, and look how far this goes back. The way to read this chart, this is the zero line. So if this is below zero, that means Brent is higher, priced higher than WTI. If it is above here, then WTI is priced higher than Brent. So we can go back in time, and it's happened for brief periods like around COVID, and another brief period in 2014, 2016. But the last time that it's really been a different market was about 2011. So that is 15 years ago. So what we're looking at now is we're looking at where Brent is now discount to WTI. So we're going to explore why. Now, we're also going to talk about what WTI is, what Brent is, and how this interrelationship is so important. This isn't just a blip, it's a historic signal. And most people have missed this entirely. American oil just got more expensive than the global benchmark. Most of the globe trades off Brent. Most of North America trades off WTI. So that is important to understand. I also threw in here a little visual to show where we are today, which is over $110. We've since priced off back down from there. So what we can see is by September, we're expected to be at 80 or below. So what this is saying is that the traded market is anticipating that this event is really only going to be applicable for 3 or 4 months. So that's important to understand. Now, this is the crossover that nobody was watching. So let's walk through a little bit of history. This is February 28th, right here. So that is when the US first struck Iran. And then we've had a continual uptick, then sideways uptick, then a retraction, and now we're sitting right around $100. So there's a lot of expectations about where it may go and whatnot. I'm going to lean a little further away from that and more about the relationship of WTI and Brent, because the interrelationship of where we're going on price is going to change day in and day out. So this is a very fluid situation. So a lot can change overnight or over weekends. So this is, let's see, there we go. If I can get my thing to work. Okay, what is WTI and Brent anyway? So before we get into all the drama that's been happening, WTI is a benchmark for pricing of light, sweet crude from the Permian Basin priced at Cushing, Oklahoma. So what this means is it's two different locations in the United States. One is West Texas, which is more identified with Permian. That is the quality, but it's priced in Cushing, Oklahoma, where one of the largest storage networks is in the United States. And this is a landlocked pipeline hub. And this is the US domestic benchmark. And it extends up into Canada, it extends down into Mexico, and even down to South America. Brent crude, on the other hand, is originally from North Sea fields, and it's mostly now a financial benchmark. But a lot of the North Sea fields had a lot of production there. Well, they just extended the Brent crude benchmark to countries in Africa down in Nigeria, and all the oil producing countries in Africa utilize Brent crude. Also in the Middle East, Brent crude is used as a benchmark. So you can think about it in terms of a Western hemisphere and an Eastern hemisphere. Um, and it's usually priced higher. Now, one thing that is important to understand is the quality difference. West Texas Intermediate is a lighter barrel, marginally, than a Brent crude barrel on the margin. That's what we're talking about. So typically, there is kind of a fundamental barrel for barrel on the heating value and the refining value, maybe about a 30 to 50 cent increased value with the Brent crude as opposed to WTI. And we can get into this because it gets into light and heavy crude. So light crude is easier to refine, so it's cheaper to refine, but you don't get as much of the products that you really want back out of it, like the jet fuels, the diesels, whereas Brent crude and heavier crudes typically have that, and most of the Middle East has that. So landlocked versus global. One core difference is WTI is landlocked in Cushing, Oklahoma, and WTI has to leave the pipeline hub in Oklahoma first, whereas a refinery in Singapore can't just call and order it. Brent tanker picks it up 40%. So we are going to touch on the Strait of Hormuz because that is very timely right now. Again, this is April 13th, 2026. I'm recording this for Wednesday, April 15th, so it could be even different by then. But the reason that's important is the Strait of Hormuz is currently shut in, and the U.S. has added a blockade of ships back behind that shut in. So but 40% of the global crude market flows to destination via ship. Most of those barrels are actually priced on a Brent. And this is where a tanker picks it up in the North Sea and takes it anywhere in the world, North Sea and or Middle East and or Nigeria, Mozambique. A lot of different countries actually follow the same pattern. So oil is oil. And the myth is that this is the myth that costs traders money, because a common belief is a barrel is a barrel, crude is crude. The price should be the same everywhere. The reality is there's two different metrics or three different metrics that should be looked at for the valuation of the crude oil. One is quality, which is a light sweet versus heavy sour. They have different refining costs, but also different product slates on the other side of the refinery. So that's important to understand. And hey, if this is your first time here, I'm Brian with Energy Rogue. And listen, we talk about energy markets every single week. If you have an idea or you want to talk about the energy markets, just drop a comment down below. We'll be happy to address that and get that into the pipeline of content. So we run a company called Energy Rogue to help people understand the market. There is a free ebook down below in understanding oil and gas markets in just 5 minutes a day. That's down below. Or if you follow markets, you can go to energyrogue.com, link below, and learn a little bit about our services, which is basically meant to equip you to understand everything about the energy markets fundamentally and technically, so that you can understand where we have been, where we are, and where we're going. So the first step is that quality. Is it light, sweet, heavy, sour? There's a refining cost variable, whereas light sweet is easier to refine. But the heavy sour actually gives you different products that may actually be more valuable. So there's a trade-off there. Second is a location. Where is the location of WTI? Where is the location of Brent? And then the deliverability, days to load versus weeks. How quick can it get there? What is the ultimate rationale? And one thing that we look at that I always try to route people through is this is inside of our platform. If you follow energy markets, you should have Energy Rogue or something that looks like this. Ours, yeah, I'm going to brag. I think ours is the best dollar for the money. Most of our members are traders, hedge funds, producers, consumers from around the globe. We have customers in 5 different continents and 32 out of 50 states. So we have a broad cross section of different personalities, disciplines, CFOs, traders, analysts, physical traders, financial traders, and people planning their business on the production side and consumption side. But one thing that I typically try to root or remind people of is that we are producing about 13 million barrels a day, 13.5, where inputs to refineries is over 16 million barrels a day. So that means we need to net import crude to fill that. But here's where it gets interesting. We actually import 6 million barrels a day, which is way more than we need. But we export over 4 million barrels a day. And right now, something interesting is happening. Week over week, we're over 17% raising on our exports versus 1 year, about close to 30% and over 40% higher than the 3-year average. So for this time of year. So that's what's important to understand. You may ask yourself, well, why do we import and export? Has to do with what we're talking about here, which is the quality. One of the main reasons is most of the crude in the US is that light sweet, and most of our refineries like that heavy sour. Most of the imports actually come from Canada, so they're not seaborne, but we do get about 10% from the Middle East. Well, prior to February 28th, I should say. So the surprising part, WTI used to be a premium grade. WTI is actually a higher quality than Brent because it's cheaper to refine. It was a premium for most of the history. Pre-2010, WTI traded at a premium or near parity. And then US production was starting to decline, Cushing balanced. Then the shale boom really took off in the 2010s. It started in the 2000s, but 2007, but it really took off in the 2010s. Production exploded, and Cushing fills up. Export ban traps the barrels. WTI crashes to a $20 to $25 discount. Then in February 2026, let's fast forward. There is no more export ban. The U.S. is actively exporting crude oil and refined products. And on February 28th, after the attack started, WTI inverted. It took about a month for this inversion to happen, but the new normal just broke. So there's a lot of questions why, and we'll get to the why at the end. So the 3 eras of the WTI-Brent relationship. Pre-shale, WTI traded at a modest premium. Shale boom, WTI discounted widened to $20 to $25. As we can see here, that didn't last for an incredibly long time. Let's actually go back in time. And what we can see is down here from 2011 to 2014 is when there was a large disconnect between Brent, but then it kind of stabilized inside the $10 range, which is right here. And you can see probably most of the time inside of this $5 range. So usually 0 to 5 is where most of the activity has been for the last 10 years. And then what you can see is this little blip at the end where WTI is now trading premium to Brent. And what we can see is after February 28th, we had a lot of weird activity, actually expanded out. Brent actually took close to an $18 premium, and then it's since reversed. Now, part of the reason is because of this import export. Our exports are up, so there's more demand for crude exports coming out of non Strait of Hormuz crude oil, or crude that doesn't have to go through that constraint. So that's actually what's one of the things that's happening, but there's a more complicated iteration which has to do with currency, the value of WTI, the value of the US dollar, and there's an interrelationship on the financial side as well. But now, the export era, the discount narrows to $3 to $8 for most of the time up until 2026, until that inversion happened. And the number that stopped traders cold, $25 peak Brent WTI spread. It's the widest we've seen in over 5 years. Hit that in March of 2026. 15 years since our last inversion, and $3 to $8 is the old normal. Now, why it flipped? The Hormuz shock explained 4 mechanisms that drive the inversion, each one explained in plain English. Mechanism 1, supply route collapse. Now, 20 million barrels a day, or a quarter of, 20 million barrels a day actually is no longer coming through the Strait of Hormuz. It's effectively closed right now, and now you add in the US blockade, it gets really dicey really quick. But Hormuz handles 20% of the seaborne oil and products. Okay, so it also has products coming out that way. But US crude is flowing through the Gulf of Mexico. Still fully deliverable. There is one challenge though. This route right here that is mapped through the Strait of Hormuz that comes out and goes down the Strait of Malacca and then up to China, Japan, Korea, all of those now coming from the US, it's going to have to go twice as long. So this, even if the strait opens today, there's probably going to be a year of corrections that are going to be happening. So mechanism 2 is extreme backwardation. So a lot of traders talking contango, backwardation. And when you have contango, that means the price in the future is higher than the price today. When you have backwardation, you have the price today being high and the price in the future being low. So this is buyers are paying more for crude they can get right now. So when you look at the chart I was showing earlier, you have WTI showing over 110. It's back down to 100 right now. But this shows that by the time we get to September, we're $80 and below. So this is basically traders saying this event will be short-lived. So mechanism 3 is the SPR buffer. Okay, the Strategic Petroleum Reserve. These are reserve barrels that are rerouted and in the Atlantic Basin to domestic refiners. And what this means is U.S. inventories are currently at about 464 million barrels, 2% above the 5-year average, but it is down versus history. So the 5-year average includes a lot of the activity from the Russia-Ukraine war. So that is important to understand because there was some releases during that period. So this is a counterintuitive effect, and relative U.S. abundance is bearish for WTI versus Brent. Okay, I want to say that again. Relative U.S. abundance is bearish for WTI versus Brent. Now, for context on strategic petroleum reserves, I was talking about U.S. inventories. IEA has another inventory over 400 million barrels. Sounds like a lot, but if we're talking the Strait of Hormuz, we're talking about 20 million barrels a day is impacted. Is that really enough? It's 20 days. So that is 20 days to fully offset the Strait of Hormuz shut-in. And guess what? This has been happening for 45 days. So we haven't worked through all the inlets and outlets of the demand shock and supply shock. This is where we were in March of 2020. We did not have a clue what this is going to impact because this global crude oil shortage and LNG shortage is going to show up in food prices via nitrogen fertilizer, via via helium, which is going to impact space programs and the medical industry and military programs. And add in metals. This is going to impact metals. So there's a lot of ancillary things that this is going to affect. Food is going to be the predominant one, though. So the war risk premium. There's a bypass premium right now. Any crude that doesn't require transiting the Hormuz, the Red Sea, or other contested waterways is worth more right now. That's just plain and simple fact. Because right now, going through the Strait of Hormuz, there used to be 130 to 140 ships. It is now about 10 to 15, sometimes single digits. So WTI is exported via Houston or Corpus Christi, and it bypasses all those choke points. And week over week, we grew by 300,000 barrels a day. So our exports are increasing. So what is the spread telling you right now? So the current is holding a $2 premium to Brent, and this is indicating that I'm sorry. If we go to $2 Brent as the premium, this shows that the inversion is over and that we're going back to historic levels. That means everything is stabilized. If the spread widens, that means the Hormuz is fully closed. Global buyers, and none of this is trading advice. You can read our disclaimers down below. This is just me talking as a commodity trader since the mid 1990s. I've traded every commodity physically and financially, and it's really important to understand the physical versus the financial. And that's part of the reason that we created Energy Rogue. Is all of this physical right here is the underlying structure behind the traded market. So if the spread widens, that means the situation has gotten more dire. If it narrows, that means that there's going to be some easing or lightening on that. So let's talk about the decision tree. Narrowing to $3 to $5, Hormuz reopens. Peace deal. Widens to $15 plus, Hormuz is shut, and escalation. I don't see this as a real case on widening. On widening, I probably would cap out about $10. I don't think it's going to get wider than that, mainly because export capacities out of the existing places in North America and South America don't have enough excess capacity to meet that demand. And the current spread is going to be a $3 to $8 Brent premium. So backwardation, contango, we talked a little bit about that. The tanker time bomb, 230 loaded tankers are waiting. Each one of those tankers is holding 1 million to 2 million barrels a day, or not a day, 1 million to 2 million barrels. So you can think about it this way. We have 400 million in strategic petroleum reserves. You've got half of that sitting on ships right now. It's currently sitting in the Persian Gulf with nowhere to go, and there's critical WTI Fibonacci support at 94.67. When Hormuz reopens, days, weeks, or months from now, that those 230 tankers will flood the market simultaneously, replenishing some of the storage and stocks that have been drawn down. The price reversal will be sudden and severe. Now, what I'm thinking about right now is really looking at that spread and the correlation and what it actually means to the market. And so putting it in simple terms, what the spread is, it's quality plus location plus deliverability. That's what comprises the spread. Now, I want to note something. Most of the trading activity for WTI and most of the trading activity by Brent are not people in the physical space. So there is a disconnect that does exist between the financial traded entities or contracts and the physical. And it's part of the reason that you see disconnects. And right now, I think one of the disconnects is trying to triangulate why WTI is over Brent. And I think the simple answer is there's more demand for WTI related barrels for export for purchasing out in the marketplace. So they're bidding it up. Um, so why it flipped? Hormuz shock, backwardation, SPR buffer, and war risk premium. And what it tells you, watch $3 to $5 for reopening, 15 to 25 on escalation, and the spread will move first. So listen, if you follow energy markets, we created energy markets. We created energyrogue.com, and the link down below, you'll find out a little bit more about us. And we help traders, producers, consumers understand what's happening out in the marketplace. And this is part of the reason that when we're looking into the market, we're trying to figure out exactly what the market is telling you. So traders, producers, end users, if you're a consumer, and you can go down and choose whether or not whether or not you want to choose Rogue Radar or Rogue Edge. Rogue Edges are full, complete package, whereas Rogue Radar reads more like a newsletter and keeps you on top of the events. So normally these are priced a bit higher. We do have them on sale or discount right now. There is a link down below. Now, if you want to understand how to approach oil and gas markets, there's a free ebook back down below. So that's going to be the first link that you see. But this is going to dictate the rest of the year and into 2027. And that WTI to Brent relationship is going to be changing and evolving. And we've actually seen people make a tremendous amount of money in trades. And again, not trading advice, this is just my opinion, but we've seen people make a lot of income there. But more importantly, I'm hopeful and hopeful for peace. I'm hopeful for uh, attacks to stop on all sides, because I don't like it, because it impacts people's lives. So this is going to impact markets. It's going to impact equity markets. And one thing I can say for sure, I don't think WTI or Brent is really pricing in the full impact of this yet. So there could be a supply shock that takes us up. Now, what the market is pricing in is a very sizable demand shock, which hasn't been felt yet in the West. I think it's going to start to be I think it's going to start to be felt very, very soon. So that's my 2 cents. Drop me a comment, drop me a like if you appreciate this, share it with a friend, and listen. Thanks so much for spending some time with me, and I hope you have a safe and happy day. And I'm here. I'm Brian, Energy Rogue, and we will be back next week. If you have an idea for something, drop it in the comment below. See ya.